Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Today, our show is called Show Me the Money. We're talking about the capital stack, financing, debt, loans. That's what we're talking about today. And please welcome my next guest. It's Steve Renna. He's president and CEO of CRE Finance Council. Now, they're a trade association. They are basically the voice for commercial real estate finance. He's joining us on the phone. Steve, thanks for being with us.
Michael, it's always a pleasure to be here.
Well, we appreciate you being on. And to get us started, let us know, the listeners and viewers know, really how important is a strong and liquid debt market to the commercial real estate industry and ultimately to all the businesses that occupy commercial real estate?
Yes. Thanks for that question, Michael. Basically, what liquidity means is that a seller is going to be able to find a price in the marketplace that is within the seller's expectation range and could be able to execute. So that's the liquidity, is being able to have some sort of price certainty, and that there are buyers out there to meet that price certainty. When you get into a dysfunctional or illiquid market, there's so much price volatility out there that a seller doesn't know what the price of a loan can be sold at in the future. And if that's the case, what you get is what is going on right now in the industry is a lot of loan originators are saying, I just can't originate a loan to a borrower's term sheet because I have no idea what I'm going to be able to sell that loan, whether it's in CMBS or otherwise. I don't even know what's on the other side.
Right, and that's important because the flow of money, the debt market, can really start to create the downturn in a cycle, right? If financing's hard to get or difficult to get, rates rise, underwriting stiffens, you can create some problem with values, and then the whole thing can start rolling downhill, right?
Right, it becomes kind of a downward spiral that starts to become self-perpetuating, too, and that's the concern.
Yeah, and I guess there's a lot of concerns about the new regulations, on banks and lenders, and you guys are handling that firsthand for lenders and for borrowers alike. So what are the concerns of the lenders today with these new regulations?
Yes, and I think as you think of Dickens sometimes, and when he was writing Tale of Two Cities, he said, it's the best of times, it's the worst of times. And if you're in the capital market sector right now, I think you're looking at things as the worst of times. You have very high degree of dysfunction in the capital marketplace right now. Reasons for that, obviously there are a number of external factors that are weighing on the economy, what's going on in China, oil prices, commodities generally, sluggish performance of our economy, poor performance overseas. But on top of that, you are getting a wave of significant regulations coming into play for the capital markets that they've never had to incur these types of regulations before for Dodd-Frank, Basel related regulations. So you're in a bad time in the market cycle right now with respect to just external influences on capital markets, and then you have this very significant regulatory burden that not only has a weight to it, but it has a high degree of uncertainty to it as well. And so that is creating dysfunction in the marketplace, or it's adding to dysfunction in the marketplace. And in CMBS, you have mortgage originators and even some securitization platforms questioning the viability of being able to go forward. It is a very difficult time right now, and there's a lot of opacity as to what is in store in the future. We are in a year, Michael, I'm sure many of your listeners know that 2016, 2017, 2018 are the peak refinancing years for maturities of CMBS loans that were made in 2006, 7, and 8. So we're facing over $100 billion of maturities in CMBS right now. And just last week, there was a researcher from Morgan Stanley who downgraded his estimate on CMBS issuance from over $100 billion at the beginning of the year to now $70 billion. So capacity is leaving the marketplace very, very quickly.
And it's not a good time for that, is it? And some of these regulations, they really haven't hit us yet. They're just about to impact the industry, right?
That's right, and risk retention is probably the biggest one right now, and the industry is trying to grapple with how it raises the necessary amount of capital to fulfill the risk retention requirements. The problem is that the regulations do not give really much guidance at all to how you can form capital in order to achieve risk retention. But they basically say, if we determine that you don't comply with the risk retention rules, yet there's very little guidance in them, and you violate them, and then for instance, you could put a securitization out there, and then the regulators look at it later on and say, this didn't comply with risk retention. The issuer is on the hook for this, and they are very concerned that they could lose access to their shelf or some other kind of penalty. So they are putting a lot of pressure on the B-piece buyers, who are the ones that are raising this risk retention capital, to basically, you raise the capital that's needed, and it's going to be capital that has to be held, no transferability for any of your investors for 10 years. So that kind of buy and hold investment capital is hard to find and expensive to raise. And if that's the case, it's going to be pushed back down through to the borrower in their coupon or the proceeds.
Right. And it could become difficult. And, we're already hearing noise in the industry that, prices and values have kind of topped out. And if we have trouble getting financing, that downward spiral could start. And we're going to have to take a quick break. But when we get back, I want to ask Steve about underwriting and about the banks and how all this could impact borrowers, and then maybe some tips of how to handle the situation. So stay with us. This is the Commercial Real Estate Show. I'm Michael Bull. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about debt financing loans. My guest is Steve Renna. He's President and CEO of CRE Finance Council. And Steve, how are banks feeling about the kind of the new regulations, the commercial real estate market, and their current underwriting standards?
Sure. I think I'd sum it up this way, Michael, in that from the regulator's perspective, a bond is a bad four-letter word, and a loan is a good four-letter word. So if a loan is securitized, the regulators are treating that harshly. If the loan is kept on balance sheet, then it gets more favorable capital reserve treatment. So basically, when you look at the banks, they have two houses in which they're making commercial real estate loans. If it's a large bank and it's involved in CMBS, it's making CMBS loans that are 10-year term, they are fixed rate, and they are non-recourse. If they're on the balance sheet side of the equation, those loans are going to be shorter term, 3, 5, maybe 7 years. They're going to have a recourse component most likely, and they're most likely to be floating rate. So, you have basically different business models. Right now, I think the banks on the balance sheet side are able to be, pretty fully functional with that. On the CMBS side, as I said in the earlier segment of the program, things are becoming quite problematic.
Right. And as a borrower, obviously you love the non-recourse 10-year notes, so we don't want that to dry up.
Right. I would say, too, when people ask about underwriting, you and I have talked about that earlier, and there, are there concerns about underwriting standards slipping? I'd say I think for the most part, the answer is underwriting standards are holding up quite well. I mean, one of the things that we saw, pre-crisis was a lot of pro forma underwriting. That has not yet come back into the marketplace at all. Nonetheless, on the CMBS side, you have over 40 origination platforms, and so you have a lot of smaller shops that don't have any balance sheet themselves. They're given a warehouse line of credit, and they have to be able to make a loan for sale in order to make any money. And I think people are seeing that some shops are really kind of pushing the parameters of underwriting in order to win the loan from a borrower to so they can make the sale, and that's putting pressure on underwriting.
Yeah, and there's some real good news though in the debt market, right? It was related to how much debt is on commercial real estate. So if you compared the average loan to value ratio in commercial real estate loans today to pre-recession times, what do you see?
LTV is definitely lower, for sure, on that, and debt service coverage ratio is typically higher, although you do have lower cap rates. I mean, there's a lot of cap rate compression out there.
Yeah, so you would think the outside looking in would say, well, we're in a much safer market when it comes to commercial real estate loans and properties if there's a lot less debt, if they're 60% debt and not 90%, right?
Right. There's interesting too, and I don't want to overemphasize on CMBS, but you have CMBS bond investors basically asking for corporate junk bond type of yields, yet the property fundamentals the properties that are underlying the mortgages in these pools are quite strong and even improving. So there's a kind of a disconnect there. But I think the good news in the market is that property fundamentals are strong. But of course, as we saw during the downturn, Michael, when liquidity dries up, property fundamentals cannot hold up. And if borrowers go into distress because of lack of liquidity and capital and credit out there, then the values of their property are going to start to suffer, and you're going to get banks taking more property, in REO, and that becomes problematic. They have to deal with those distressed pools, and that's not good for anybody, even if you're not in a distressed borrower.
Yeah, good point. Well, Steve, we're out of time. We appreciate you joining us today.
Always my pleasure, Michael.
Thank you. And if you'd like more information from Steve, their website has some valuable information on it. Visit their website, and we'll have the link on the show website. And next week, you've got to join us. We're going to talk about the restaurant industry, which has been a major impact in commercial real estate. So join us next week. And until then, be sure you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate asset and occupancy solutions. Visit bullrealty.com. CCIM Institute, commercial real estate's global standard for professional achievement. Visit ccim.com/CRE show. Xceligent, providing verified commercial real estate information across the United States. Visit xceligent.com.